Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining us. I'm your host, Lance Pederson. This is the Real Estate Risk Report. So today I have the guest that we've been having on several times. We'll continue to have on who serves as sort of our center. The one who will bring us back to sort of to the center in the middle and kind of balance us out, since we spent most of our episodes and shows kind of really digging in and, pulling apart risk mitigation strategies and, different strategies that people are executing within sort of this middle market real estate space. So happy to join Ryan Parson with the Mile Marker Club. Thanks for joining us today again, Ryan.
It's always great to be here, Lance. Thanks for having me back. And I appreciate being able to really be part of this, this greater discussion that you're having about, risk in real estate. And like you just said a moment ago, how you really look at all of that and try to tie it all together to, have good long-term success with whatever you're investing in, really.
Yeah, I know, exactly. And I think that's sort of the topic of the day, right? Is to sort of, it's great to sort of, figure out and, you vet a sponsor and, you feel really good about them. And, hey, you got to the point where you trust these guys and they come up with a deal and it's this really great deal that they got off market. And, that's great. I mean, that's obviously part of the process. Like we've talked about, over and over and over again, is you've developed those relationships to get yourself to a point where you know enough to know that you believe in the mandate for a specific deal. But once again, it comes down to all of us have a finite amount of wealth, right? I mean, there's a portfolio. There is your investment portfolio, as Ryan says, you're the CEO of your money, right? Like you've got this thing that there's more to it than just, falling in love with a specific investment opportunity. And ultimately your decision about how much, hey, you love this deal or whatever, right? But you have to be conscious about how much capital you're going to be allocating to that specific deal, right? Do you, if you have the means and the wherewithal that you could, stroke a $500,000 check and maybe receive enhanced economics, or stroke a $50,000 check and still get into the deal and have exposure to it, is sort of, where Ryan plays, right? Is that Ryan works with his members, right, to sort of be that for them. Like, let's pull out and just make sure, like, great, we got to do all the diligence, fall in love with the deal. But ultimately, how do we determine whether or not that deal is going to solve a specific problem within your portfolio, and that we're going to build a portfolio that is balanced, so to speak, right? And so, with that said, I know you've got kind of this sort of like way of looking at it, these five components. Maybe share a little bit with us kind of your current thinking about how you go about making sure you're not out of whack on that allocation side.
Absolutely, Lance. Again, thanks for having me here. And, as we, where we're at in the cycle, a year more or less into this, terrible pandemic that is stricken the entire globe and the entire human race, Lance. And, there's been, constant distraction out there for all of us as investors, both in the traditional investment markets, certainly the alternative and real estate investment markets. And we have to, as investors, really take stock and remember, what is it that we want? What is part of living our best life as an investor look like, in spite of all of the craziness that's happening around us? And one of these things that I really, have taken stock of this last year is, as we work with our members to really think through what some of these implications mean to me, or mean to them, and mean to me as an investor too, is what I call the Treasury management, and those five elements, Lance, that you just mentioned a moment ago, seem to be the things that we're taking greater stock with today, to drive back towards the mean. And I guess what I referring to with that, in any statistical modeling, and not to make this a statistics discussion, but
right.
Usually in anything that you're looking at, it always reverts to the mean. It always reverts to the center, and it always kind of comes back. I don't want to use mainstream. That's probably not the right word for it, but it comes back to a central spot.
Yeah.
And for most of us in our investment portfolio, there's going to be a central lane to run in. Now, that lane is certainly different from investor to investor. Your risk tolerances, Lance, and things that you might want to invest in aren't going to look like mine, and it's not going to look like the next high net worth investors. And nor should it, by the way, because that's part of the reason we all get into alternatives, or at least one reason anyway, to create diversification, to create different risk exposures, to create different types of return profiles. And that's part of the beauty of alternatives, and certainly real estate being a part of that. But at each of us as an individual investor, there's going to be a central tendency that we have to identify and define within our own wealth. So we've got a well risk managed pathway to go down as we consider making new investments, especially with alternatives that don't have as much of that day-to-day reporting. You look at the stock market, it's up here, it's down there, it's across the way. You don't see as much of that to understand maybe like some of the what I call the turbulence, or another way to think of it is volatility. And of course, Lance, said with what you and Verivest are doing is to help bring more and more of that transparency to individual real estate deals, to help from a turbulence. I guess we can start with that one, kind of these 5 elements of treasury management: turbulence, taxes, the timing of cash flow, the targets in your portfolio, and the types of deals. So maybe those are kind of the 5, but starting off with this turbulence or volatility, all of us as investors, we all say, well, we want a smooth ride. We don't want volatility, but yet a lot of our portfolios have irregular valuations and irregular movements in them. And so being able to understand where your portfolio is at from a turbulence standpoint is it really smooth, or is it irregular? In reality, there's probably something in there where you're going to take on some types of deals that have got more volatility or turbulence to them, but it's got to be across the board with all of your alternatives that you've got to be able to get a good handle on.
Yeah, I think you're right. I mean, it's just like you said, is that if you kind of feast at which we saw a lot, especially in the run up here, especially toward the end of that last cycle, was just a lot of people sort of feasting on these 18, 19, 20, 21, 22 IRR sort of targets, which is really code for deeper value add, multi, or whatever it is, some deeper value add strategy. So, now once again, you don't have the liquidity, right? So it's you don't have the, like you said, the ability to view and see the volatility, right? The ups and downs, but whether you know it or not, that there is much more volatility in that particular strategy, because things can go sideways and you can see it kind of go like, hey, I thought we were on the right track, but no, we're stuck. Now we're going back the other direction. Look no further than anyone who, if you go in and you had all these sort of bidding wars and everyone, really got really competitive. So of course that pushes up the price. Yes. And then, if you had the great fortune of being the winner of said auction, which is code for overpaying for the asset, right? Of course, not you, it's someone else that you basically, put your money into that had that great fortune, and you indirectly, now, and all of a sudden, boom, global pandemic. Well, that business plan didn't count. It didn't count on there being a global pandemic. And it doesn't matter, what's going on. It didn't account for that. It wasn't underwritten for, because if they underwrote for pandemic, no one would ever do deals. So now all of a sudden that volatility exists because now you're like, crap, we overpaid for it. We can't move the needle. And that means that this thing's going to stagnate and maybe go the other direction, meaning like you're just going to spin your wheels. You can't execute the strategy. Your vacancy's, too high. And you're kind of stuck. Not to mention, in worst case scenario, you blow covenants, and now you're like in special servicing and trying to work out. Okay, turbulence, That is turbulence. Whereas buying something that was stable, let's just use triple net, right? Because they're the easy target, sort of like triple net with a, with a high credit quality tenant, long-term, whatever. I mean, that thing is just, it doesn't have much turbulence. It just, you knew what you were getting into when you got into it. It is what it is, right? And it's not going to move much on you. I mean, in the real estate parlance, right? So that turbulence, but now taking a whole basket of these things because you became a hobbyist and you fell in love with alts, and you're throwing 20 grand in every damn crowdfunding deal you run across or something. Now all of a sudden you got 30 of these. I think that's what you're referring to, is that you probably didn't account for just the fact that you kind of over allocated to a given type, right?
Yeah, that and every deal, every asset class, every structure, you've got to be able to assign some level of turbulence, based on where your existing portfolio is at, given these unknowns that none of us expected a year ago, Lance. We'd be talking about a pandemic really, or almost just over a year ago now, I guess. But yet this is part of the new marketplace reality. And so now that we know this, it's imperative for us as investors to look really hard and be honest at ourselves and make an assessment of how turbulent are all of our alternatives. And that's one of these elements of, again, what I call treasury management today, that we're having to do with a much more eagle eye than, really what most of us or any of us ever thought of doing, given these different types of volatile points in the marketplace. So I think this idea of turbulence, and this applies to, Lance, even with traditional stock market investments, but it's, for obviously all of us have alternatives or real estate in our portfolios. So because hopefully we're a little more intimate with our alternatives, it might be a little easier for us to create that assessment of what that
potentially. But to your point, I think you kind of mentioned it indirectly, right? But that's part of the trouble, right? Is that in most of these deals that you go into, especially syndications, some of the funds, obviously open-ended funds, kind of are marking to market, or evergreen funds. So that gives you a little bit more of an indicator. But usually those are internal desktop valuations. So take them with a grain of salt. And but that's kind of the hard part, right? Is that most of the stuff is held at book, which means whatever they have into it, the cost basis. And so for you as the investor, you have to be in this sort of translating function, right? Because I think that to me, that's a big issue. And I think that most people aren't maybe even thinking about it or don't want to think about it. But if the sponsor is not making a mark, it's not being booked up or down on the balance sheet, which it more than likely isn't, right? Then you have to sort of figure that out, right? To your point, because see, it's what's the residual value left in the investment. And that's usually the part of the equation that's not filled in. That's the unknown variable, right? And the only way to solve for that variable is to determine what that asset is worth, what you think it's worth today on a liquidated basis, right? If we just sell it. And that's my point, is that if anyone who overpaid at the top of the market, there's a bunch of these assets who are never, ever, 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 even through this next cycle, going to end up selling for the amount that they paid for it. Okay, that means that you got to look at which ones of those fit that criteria, because what you thought you were going to get or what's going to come out the other end is never going to materialize.
Well, that's it is, and it's, look, every investment has risk, Lance. You know that. Everyone knows that fundamentally, but it's hard to want to acknowledge that if indeed it's happening. What you just mentioned, I'm an investor in syndications, amongst a whole different types of things. I've had syndications, managers have to say to me, Ryan, we've had to stop distributing because of the pandemic. And that's probably the right decision to make sure the project can at least,
of course, get
to some sort of a finish line. And to your point, it won't be the same finish line that we necessarily started with. My point when I talk about this target, being one of these elements of treasury management, we may have gone into a deal, take late 2019 or even in Q1 in 2020, before we really understood what was happening with the pandemic, and thought it was going to be a good income producing deal, a syndication and a multifamily or syndication and whatever it was going to be an income deal. But now, because they've had to stop distributing for an indefinite period of time, which again may very well be the right thing to do from the project, it's now turned into a growth element. Instead of an income, it's a growth. And we as an investor, when we look at our portfolio, have got to be honest with ourselves and realize the makeup of our portfolio may have changed. Not because the sponsor did anything wrong, or not because you as the investor did anything wrong. You just have got to acknowledge this is the new reality of your wealth. And that's one of those movements that we're seeing, that you've got to really take stock in. And what is it, what you thought you were targeting, an income or growth deal, but now it's something else because the market caused the change.
Well, that's right. And I think that's where, we all love to, it's whole like the mystery of the IRR sort of thing. But fundamentally, that's what IRR is saying. You should expect, the internal rate of return means, 5-year target out the other end. And when all is said and done and settled, some amount of the IRR, of course, is cash flow. Okay, well, that turned off. And now all of a sudden, it's certainly not going to, because if there's no cash flow, now the chance of the IRR being 18 is, diminished significantly. And now all of a sudden you said, maybe there's some growth there, but once again, who knows? And if the cycle, right? We had a 9-year bull run up one direction. If this thing, none of us know, right? But the point is that IRR, internal rate of return, when you annualize it out, which is what everyone sort of thinks about. They think, well, right now we're in a zero interest rate environment, which means I can't get anything off of just it savings, like as close to risk-free as I can. The risk-free return is very low, right? That's basically what it means, right? So you got to put, cash is the devil, right? You got to put it to work. Otherwise inflation is working against you, right? So, but now if this thing gets strung out and they got to hold on to the asset before they can find themselves in another market where they can sort of recoup, that means that you could, when all said and done, that IRR, and being a guy who plugs numbers into spreadsheets a lot and sort of sees this, I look at, you change those dates, now all of a sudden, the longer it goes, now you're at, 3%, 4%, 5%, right? But this is the knock on it. The knock on alts is their lack of liquidity. Yes. So because now there's nothing you can do. It's the Hotel California, man. You come in, you never get out. You can't get out until this thing goes full cycle. And if it's not going to go full cycle, it ends up in potentially being effectively dead money, or it's basically going to keep ahead of inflation, right? So your point is, that's what's happening. Whether you want to acknowledge it or not, you're saying, folks, it's time to acknowledge it. You have to acknowledge what you've got.
Well, that's right. And that's, from our standpoint, Lance, so much of what we teach and help our families that we serve is, part of that wealth organization process. You got to get real with your wealth and these components of your investments in order to understand, given the market shifts that have happened now very dramatically. Different asset classes we're investing today weren't even on the radar screen a year ago, Lance, and you're familiar with some of those. Verivest does a lot of the admin for these new types of structures, but it's hard to know where to go with even these new opportunities other than, you get enamored. Wow, that's cool, or this is cool. It may be cool in and of itself, but it doesn't mean it's cool for your wealth in your portfolio if you're doing things that may not be as productive given the current confines of your wealth. And, one of those, as you were just talking about that, look, deals change. It happens, and it's just part of the risk that we as investors have to take on, but it's how we manage that risk. And, another one of these pieces are taxes. Taxes are a normal part of all of our life, but if you've got deals that are not distributing now, for good reason, but the deal might still be making income. Several of us that thought we were going to have current taxes due and then the current cash flow to pay those taxes with from the deal are going to find ourselves having a current tax situation with less cash to actually pay those taxes. And so this idea of looking at taxes from a treasury management, were you expecting to have a current tax bill, or do you expect to have a future tax bill? Just depending, each deal is going to be a little bit different, but that's kind of the third big thing, Lance, that we as investors have got to take stock with today that's triggering current taxes but we're going to have to pay it with something that we're not going to see until the future, if that makes sense.
No, it does. It makes perfect sense. Yeah, your cash flow, spigot got turned off, and the benefit and the beauty of bonus or accelerated or any depreciation still wasn't sopping up or taking, offsetting all of the income.
Correct.
Right. And so now all of a sudden that's passing up to you. And and if you had, a bunch of those investments sort of stop, passing on cash flow, and it basically is phantom income in the current, in that year, right? It's now all of a sudden, to your point, treasury management is knowing when the cash is going to come, right? How you deploy it, right? And manage, it's cash management. I mean, treasury management is a fancy way to say cash management.
That's right.
Well, if you need the damn money to retire and you got to pay the bills and all those things, whatever once again, it goes back to your best life. Well, if your best life, means that you don't have a job, that is paying you a paycheck, and you got to live off that, you can't, anyway, it springs and creates interesting things that you've got to deal with, right?
Well, it does. And, now that we've at least gotten through this chaotic election period and we're, starting to see some indications of where Washington and other states might be going, all of a sudden, taxes are taking on a whole new meaning. You've got volatile or turbulent markets that are taking place in a potentially changing tax environment that may not be as favorable as it has been of the recent past anyway. These are new things you have to take stock of to understand what are these situations that may help you drive. None of these individually cause you to drive a situation, but I guess the point of what we're trying to talk about today is all of us are at a different level of spectrum. And because it all drives back to a central tendency, you've got to know which ones are throwing that central tendency off. So we talk about turbulence, targets, taxes. You've brought it up, what I call, Lance, just the timing of cash flows, for those best life reasons, retirement, whatever the case might be. We sometimes, get into deals and we have to understand, when is the cash flow coming? Is it coming immediately, or is it a deferred cash flow? And neither one is right or wrong, because we all have different needs in our portfolio why we want deferred cash flows. But now, like we've just been talking about, various different reasons, deals aren't performing exactly as we thought that they were. So cash flows might be deferred. We have to look more closely at things, perhaps to backfill under current market conditions that truly are more immediate, which, by the way, may not have the same type of return that we were expecting a year ago on an immediate cash flow. So all of a sudden, that has to be a greater factor today than what it was. So the timing of this cash flow, for a whole lot of reasons, Lance, is really critical. And the last thing I'll say here, this fifth element of treasury management is type. Simply, is it a debt deal or is it an equity deal? And, generally speaking, debt has some elements of more
income.
Income or safety on the spectrum of risk than an equity deal is. But we've seen these cases, Lance, where, equity deals are dressed up like debt deals, and all of a sudden a debt deal, if it was unsecured or maybe not as secured as you thought it was, really kind of is now behaving more like an equity deal. So one of these things you really got to take stock of and be honest with yourself with your existing portfolio is, where has that drifted, debt to equity? If you thought you were pretty heavy in debt, and has some of that drifted you towards equity? And again, it's all trying to identify, where do you need to move to for new investments to keep you in that centralized, well-balanced lane.
Yeah, definitely. Yeah. And I think, like you said, the people, there's different reasons why people, sort of make equity look like debt or vice versa. A lot of it sometimes is regulatory. Sometimes it is just to fool people and be sort of, for dubious reasons. But like a good example would be like, investing using retirement money. Well, you have the whole UBIT, unrelated business income tax issue and things. So sometimes it's just easier to, structure it as a debt instrument. But like your point is that ultimately, where do the funds go? And being aware of that, because that's all that matters, is that you put funds in, whether it's an equity instrument or a debt instrument, it's that what is the, there's like sources and uses, right? Sources, your money. Uses, what is it going into? Well, if it's going down and it's funding, the equity tranche, the common equity tranche of a deal, meaning it's in first loss position down at the asset level, or to your point, like unsecured entirely, which means, okay, well then, that would be the worst case, because obviously that's whatever you put it into. I mean, it's a different story. But assuming that there's some sort of perfected interest someplace, right? Is that, it was debt going in, but ultimately it was funding the first dollar loss position on some deal. I mean, like I said, it doesn't make it wrong. It just means that you need to know what you did. So you structured it that way to get a fixed rate of interest, which may be high, right? And so now you can, it's easier to fit and as a note and has some maturity date or whatever, and avoids UBIT. But it's just all those things, like, it's never that cut and dry. And that is what makes it challenging for your average person, especially if you're a very active passive investor and you have lots of positions. Right. It's easy for that stuff to sort of, like, I think to your whole point, right? It's easy to lose track of. It's easy for it to sort of start moving to the median or whatever, that you never, maybe weren't attempting to do. That wasn't your objective. You weren't trying to make it super heavy on just all upside growth. Right. You thought that you were investing for cash flow, which I think would probably be the most common mistake, right? Is that here they read all these cash on cash returns and these syndications or whatever. And it's like, yeah, but fundamentally, once again, what was the underlying thing? It was a value added play, or, borderline opportunistic or redevelopment. You can't, it may throw off some cash somehow, some way, but like, that's not its primary objective. Its primary objective is to increase value. Right. And that's what you got to understand. So it's hard enough to make the investments, let alone to create a balanced portfolio of it.
That's right. And as high net worth investors, Lance, it's up to each one of us individually to make that decision for us, for ourselves. No one else, can tell us what we should or shouldn't have. But when you start to look at some of these technical, planning elements or technical constructs, and apply them to your wealth, not just at a deal level, it starts to, what really should be, as a result of this pandemic, Lance, give us as high net worth investors, really remove some of the chaos, remove some of the fear that we might have as investors, to realize there's going to be a lot of good things, as hard as that is to see, maybe even right now, that our wealth will be able to do out in the marketplace, to repurposing assets, to, giving tenants, giving homeowners great places to live, giving businesses, great pieces of real estate to run their businesses from, whatever the business has. And when we have that type of confidence in our wealth as a high net worth investor, there's going to be there are a lot of great things. You just got to make sure you're looking for the right things. And when you've organized your wealth, and, these are just a couple of the elements, as I call treasury management, that you look at, but I think just has a lot more, a lot of investors can relate to these types of things today, Lance, just because of what's gone on around us that we haven't taken as much stock in or put as much effort towards in recent years.
Yeah, I totally agree, Ryan. Yeah, it's great stuff. So why don't you share, where can people find you? They might be, this might really resonate with them and see that, hey, I've kind of been there. I'm in on alts. I want to figure out how to do this. So where can people learn more about you and your club and all that?
Sure. Yeah. You can just reach out to us at our website, milemarkerclub.com, and take a little bit of a look out there and see a little bit more about what we do. And then you just feel free to reach out to us. You can reach out to us on our website, and I'd love to be able to have more of a one-on-one conversation and find out what's working and what's not working. And we're glad to help however we can.
Cool. That sounds great. And we will we'll see you here in another 6 weeks, and we'll catch up and go from there.
Look forward to it, Lance. Thanks again for having me.
Yeah, my pleasure, Ryan. Thanks so much.